Maria Delgado opened her first credit card at 22 for one reason. Her car needed new brakes, and she didn't have $380 sitting in her checking account. She paid it off in 4 months, felt responsible, felt like an adult. 11 years later, she owes $11,347 across 3 cards, and she can point to the exact day it stopped being about brakes. Well, here's what's strange about her story. Maria never bought a boat, never took a reckless vacation, never had some big blowout purchase she regretted. Her balance grew $50 and $80 and $120 at a time on things that felt completely reasonable in the moment. A vet bill, a slow month at work, a wedding gift, groceries during a week her paycheck landed late. If you added up every individual decision, none of them looked like a mistake. And that's exactly the point. This isn't a story about bad decisions. It's a story about how debt grows when nobody's making a bad decision at all. Look, let's start with the number that should bother you more than it probably does. The average credit card interest rate in the US right now is around 21 to 24%, not the teaser rate on the offer that came in the mail, the real rate, the one that kicks in the moment you carry a balance past the due date. At 24%, every $1,000 you owe costs you roughly $20 a month just to exist, not to pay down, just to exist. Now here's the part almost nobody explains clearly, and it's the actual engine behind Maria's number. Minimum payments are usually set to 1 to 3% of your balance. I mean, card companies don't pick that number by accident. On a $2,000 balance at 24% APR, a 2% minimum payment is about $40. Monthly interest on that same balance is also close to $40. So her minimum payment was, most months, functionally an interest-only payment. The principal barely moved. She could pay on time, every time, feel like she was doing the right thing, and still be running in place.
Now add real life. A slow month here, a $150 charge there. Maria wasn't out here buying luxury goods. She was covering a car repair, a dentist bill, a friend's bachelorette weekend she felt she couldn't skip. Each of those, on its own, is a normal expense. Stacked over a decade, with interest compounding on top of a balance that was never really shrinking, $2,000 turns into $4,000. $4,000 turns into $7,000. And once you're carrying 3 cards instead of 1, because at some point the first one got maxed and she needed a second, the math stops being additive and starts being exponential. So compare that to her coworker Danny, who racked up almost the same $2,000 balance the same year on almost the same kind of expenses. Danny's card is sitting at $2,300, not $11,000. The difference wasn't income. They made similar salaries. The difference was that Danny happened to get a rewards card with a lower starting rate, never added a second card, and paid $100 over the minimum most months without really thinking about it, mostly because he found the app's auto-pay slider annoying to change. That's it. That's the whole difference between two people's decade. Not willpower, not character, a slightly different default setting and one fewer card in the wallet, compounding for 10 years. This is where I want to slow down, because there's a psychological pattern here that's more important than any of the numbers. Behavioral economists call it present bias. We weigh a small cost today far more heavily than a much larger cost spread out over the future. Paying $40 a month feels manageable. Owing $11,000 feels like a crisis. But those are the same decision, made 130 times in a row. Nobody sits down and chooses to owe 11 grand. People choose $40 a month, over and over, for over a decade, and the $11,000 just shows up at the end, as if it appeared out of nowhere. You know, there's a related trap called mental accounting, and it's sneakier. Maria told me she never thought of the vet bill as going into debt. She thought of it as using the card, which felt like a completely different action, even though it produced the same balance.
Money that goes onto a credit card gets mentally filed somewhere separate from real debt, the kind you'd associate with, say, a car loan or a mortgage. It has a due date and a statement and a little minimum payment box, so it reads as maintenance rather than borrowing. That framing is doing a lot of work to keep people calm about a number that would alarm them if a bank had just handed them the same amount in cash. And once a balance exists, there's a third effect worth naming, the sunk balance effect, which is really just the sunk cost fallacy wearing a different outfit. Once Maria was already carrying $4,000, adding another $150 didn't feel like a big jump. She was already in debt, so what's a bit more? That logic is exactly backwards. The $150 on top of $4,000 costs the same in interest as the first $150 ever charged, but it doesn't feel that way, because the story she was telling herself had already shifted from "I'm managing this" to "I'm already behind, so it doesn't matter much."
Right, there's a second thing working against Maria, and it's not stupidity, it's design. Minimum payment amounts are calculated to maximize how long you carry a balance, because interest is the product. It is literally the profit center. A card that gets you to pay off your balance in 6 months makes the issuer far less money than a card that keeps you revolving for 11 years. That's not a conspiracy theory, it's just the business model. Credit cards make roughly 80% of their revenue from interest and fees. When you make the minimum payment and feel like you're being responsible, you are doing exactly what the system is built for you to do. There's a cost sitting on top of all this that Maria wasn't even counting, and it's not interest, it's her credit score. Roughly 30% of a FICO score comes from credit utilization, which is just the percentage of your available credit you're actually using. The common advice is to stay under 30% and under 10% if you want your score to look genuinely strong. Maria's combined limit across 3 cards was $14,000. At an $11,347 balance, she was sitting above 80% utilization. That's not a minor ding. That's the kind of number that can knock 50 to 100 points off a score by itself, independent of whether she'd ever missed a single payment. Okay, here's why that matters beyond the number on a credit app. A lower score doesn't just risk a rejection, it raises the price of every other kind of borrowing in her life. A worse score on a car loan can mean 2 or 3 points higher APR, which on a 5-year auto loan is real money, not a rounding error. Landlords pull credit. Some employers pull credit. Insurance companies in a lot of states use credit-based scoring to help set premiums. So the $11,347 wasn't just costing Maria $215 a month in interest. It was quietly making everything else in her financial life slightly more expensive too, in ways that never show up on the card statement itself. This is also where the payoff method conversation gets a second layer. Utilization is calculated per card, not just as one blended number. So if Maria's smallest card happened to be maxed out at 95%, while her largest sat at 60%, paying that smallest one down first, even though it's not the highest rate card, could move her score faster than the Avalanche method would. That's one of the few honest arguments for Snowball beating Avalanche on more than just motivation. Sometimes it also beats it on utilization, depending on how the balances are distributed across limits. It's not automatic, and it's not the main reason to pick one method over the other, but it's a real factor worth checking on your own cards before you commit to a plan. Maria didn't know any of this the year her utilization crossed 80%. She found out when she applied for a lease renewal and got a smaller security deposit waiver than her neighbor with the same income, because his utilization sat under 20%. That was its own quiet wake-up call, sitting right alongside the interest math. Danny, for what it's worth, never crossed 20% at all. One more thing his single card and slightly bigger payments bought him without him ever noticing. So here's where it gets real for Maria. 3 years ago, she got her first real look at the full picture. Not one card statement, but all 3 side by side. $11,347. At her average blended rate, close to 23%, she was paying about $215 a month combined just in interest. Not principal, interest. That's $2,580 a year disappearing
for the privilege of owing money she'd already spent years ago on breaks and vet bills and a bachelorette party she barely remembers. That number was the wake-up call. I mean, it wasn't a moral failing. It was a math problem she'd never actually looked at directly. Here's what she did next, and this is the part that matters if you're anywhere near where she was. First, she stopped adding to the balance. This sounds obvious, but it's the step people skip because it means confronting whatever gap in the budget was causing the charges in the first place. For Maria, that meant building a genuinely embarrassing $30 a month buffer for pet expenses because the vet bills weren't going away, and pretending they would was part of how she got here. Second, she picked a payoff method and stuck with it. There are two standard ones, and picking the wrong one for your personality is its own quiet way of failing. The debt avalanche means paying minimums on everything, then throwing every spare dollar at whichever card has the highest interest rate first. This is the mathematically optimal method. It minimizes total interest paid, full stop. The debt snowball means paying off the smallest balance first, regardless of rate, so you get a fast win and close an account, then roll that payment into the next smallest. It costs slightly more in interest over time, but it's built entirely around momentum. Closing an account feels like progress in a way that watching a percentage tick down does not. Maria went Avalanche because she's a spreadsheet person, and the math genuinely motivates her. If that's not you, if the idea of tracking APRs across 3 cards makes your eyes glaze over, Snowball will probably get you further because the method you'll actually stick with beats the one that's technically optimal on paper and abandoned in month 4. Third, and this is the one people underestimate, she called her card issuers and asked for a lower rate. Just asked. A recent LendingTree survey found that the large majority of people who requested a lower APR actually got one, with an average reduction of several percentage points. Maria's highest rate card dropped from 27% to 21% with a 5-minute phone call. That's not a hack. That's a company that would rather keep a customer at a slightly lower margin than lose them entirely. 18 months in, her combined balance is down to $6,900. Still not zero, still not the finish line, but the monthly interest cost dropped from $215 to about $130, which means more of every payment is finally chipping into the principal instead of just paying rent on money she already spent. Her utilization has come down too, from over 80% to around 49%. Still not the under 30% zone that helps her score, but moving, and moving is the part that was missing for over a decade. Look, I want to be honest about something here, because this channel doesn't do the thing where the story wraps up with a bow and everyone's suddenly fine. Maria isn't debt-free. She's not going to be for another 2, maybe 3 years, depending on whether another vet bill or slow month shows up, and it probably will, because that's what real life does. There was a stretch last winter where a broken water heater put $600 back on the card she'd just gotten to zero, and she told me she almost gave up the whole system right there. What was the point of the spreadsheet if a water heater could undo 4 months of progress in one afternoon? She didn't give up. She adjusted the plan and kept going. That's a more honest ending than "and then she fixed it forever," and it's also the more useful one, because a water heater or a vet bill is coming for basically everyone watching this. What changed isn't that her life got easier. What changed is that she can see the mechanism now. She knows why the minimum payment barely moves the balance. She knows her card company built the system to keep her paying interest as long as legally possible, and she knows that the difference between her at 25 and her at 36 isn't discipline, it's that she finally looked at the number instead of looking away from it. If there's one thing to take from Maria's situation, it's this. Revolving credit card debt is almost never one bad decision. It's dozens of reasonable ones made under a system engineered to make the reasonable choice also the expensive one. The minimum payment isn't a safety net, it's a subscription to owing money, and the only way out is doing exactly what Maria eventually did. Look directly at the full number, understand what's actually driving it, and build a plan that attacks the rate, not just the vibes. Here's a gut check you can run today on your own numbers in about 2 minutes. Pull up your card balance and your APR. Divide the APR by 12, that's your rough monthly interest rate. Multiply that by your balance. That number is roughly what you're paying every month just to keep the balance where it is. If your minimum payment is close to that number, you're not paying off debt, you're renting it. Next week, we're picking up exactly where Maria left off. Debt Snowball versus Debt Avalanche, side by side with real numbers, so you can figure out which method actually gets you free faster and which one actually gets you to stick with it. Because those are not always the same answer, and most people pick the wrong one for their own personality without realizing it.